Chapter 1: Introduction to the Stock Market. Welcome to W3 Wonders. Today, we're unraveling the world of the stock market, a cornerstone of global finance and a gateway to financial growth. The stock market is a marketplace where investors buy and sell publicly traded company shares. But it's more than just numbers on a screen. It's an ecosystem that powers economies, supports businesses, and offers individuals a chance to build wealth. So how does it work? Companies go public to raise capital by selling pieces of ownership, called shares, to investors. These shares are traded on the New York Stock Exchange or NASDAQ stock exchanges. The price of a stock fluctuates based on supply and demand, which in turn are influenced by factors like company performance, market trends, and investor sentiment. Investing in the stock market is about more than just profit. It's about participating in the growth and success of businesses that shape our world. Why should you consider investing? Unlike traditional savings accounts, which often offer minimal returns, the stock market provides an opportunity for higher growth over time. It's a proven way to outpace inflation and achieve long-term financial goals. Chapter 2: Basic Terms. At the core are stocks, which represent ownership in a company. When you buy a stock, you essentially own a small portion of that company. Another key term is equities, often used interchangeably with stocks, but they specifically emphasize ownership in a company. Dividends, on the other hand, are the periodic payments some companies distribute to their shareholders as a share of profits. A bull market signifies a period of rising stock prices, reflecting investor optimism and economic growth. Initial public offering, shortly known as the IPO, is a situation when a company first offers its shares to the public, transitioning from private to public ownership. Blue chip stocks are shares of well-established, financially stable companies with a history of reliable performance and dividends. Examples include companies like Apple, Microsoft, and Coca-Cola. They are considered safe investments with steady returns. A stock index like the S&P 500 or Dow Jones Industrial Average measures the performance of a specific group of stocks. A portfolio is the collection of all financial assets an investor owns, including stocks, bonds, and mutual funds. A market order is an instruction to buy or sell a stock at the current market price, ensuring the trade is executed quickly. A limit order sets a specific price at which the stock must be bought or sold, providing greater control over transactions. Yield represents the return on investment, expressed as a percentage. A stock split occurs when a company divides its existing shares into multiple. EPS, which elaborates on earning per share, is a company's profit divided by its outstanding shares, indicating its profitability. A higher EPS suggests better financial health and attracts more investors. Volatility refers to the rate at which a stock's price increases or decreases. Highly volatile stocks can offer high returns but come with significant risk. By understanding these terms, new investors can better grasp stock market dynamics and make informed decisions. Chapter 3: Understanding Stocks and Shares. Growth stocks are tied to companies that prioritize expansion over immediate profits. These companies typically reinvest their earnings to fuel innovation and development. Value stocks, in contrast, are shares of companies that are undervalued compared to their financial metrics. These stocks can be an opportunity for investors looking to buy low and sell high. Stocks and shares are foundational elements of the stock market, representing ownership in a company. To navigate the stock market effectively, understanding the types of stocks, stock valuation methods, and how to interpret stock charts is essential. Stocks are categorized into different types based on their characteristics. Common stocks are the most prevalent type in the market. Investors' partial ownership of a company. With these, shareholders may vote on corporate policies and elect board members. However, the returns from common stocks depend on the company's performance, and dividends are not guaranteed. Preferred stocks combine features of both stocks and bonds. Unlike common stocks, they provide fixed dividends and take precedence over common stocks in the event of bankruptcy. However, preferred shareholders typically lack voting rights. These stocks are ideal for investors looking for a steady income rather than Capital appreciation. Growth stocks are issued by companies poised for rapid expansion. These stocks often reinvest earnings into the business rather than distributing dividends. Income stocks are known for their consistent. These stocks are ideal for conservative investors or retirees. Blue chip stocks come from well-established, financially stable companies with a history of reliable performance. Chapter 4. Key financial metrics to consider. When evaluating stocks, several financial metrics can guide your decisions. Stock valuation is critical to determine whether a stock is overvalued, undervalued, or fairly priced. Various methods exist to evaluate stocks effectively. The price-to-earnings ratio compares a company's stock price to its earnings per share, EPS. This metric helps investors understand how much they're paying for each dollar of earnings. The price-to-book ratio measures a company's stock price against its book value, which is the net value of its assets. This method is particularly useful for analyzing financial and real estate companies. The dividend discount model calculates the intrinsic value of a stock by estimating the present value of expected future dividends. This model works well for companies that consistently pay dividends. Discounted cash flow valuation predicts a company's value by estimating future cash flows and discounting them to their present value. This method helps assess how a stock is priced relative to its peers. Stock charts display price movements over specific time frames, such as daily, weekly, or yearly intervals. High trading volumes often indicate strong investor interest and can confirm price movements, while low volumes might signal indecision. Support levels are price points where a stock tends to find buying interest, preventing it from falling further. While they're not guarantees, they can provide a solid foundation for making informed investment choices. Chapter 5. Investing strategies for beginners. Adopting proven approaches can set the stage for long-term financial growth. Among the most effective strategies are dollar-cost averaging. Let's talk about some of the strategies that you must be aware of when investing. Dollar-cost averaging is a method that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy minimizes the impact of market volatility by spreading purchases over time. Value investing. Value investing focuses on identifying stocks that are undervalued relative to their intrinsic worth. This approach relies heavily on thorough research, including studying a company's financial health, industry position, and future potential. Growth investing. Growth investing targets companies that exhibit significant potential for expansion. These companies often reinvest profits into scaling operations rather than paying dividends. Index fund investing. Index fund investing involves putting money into funds that track a specific market index. Chapter 6. Conclusion. The stock market is a powerful tool for building wealth, but success requires education, patience, and a clear strategy. Today, we've covered the basics of the stock market, key terms, strategies, and how to start investing. Remember, every great investor was once a beginner. Take the first step, keep learning, and stay committed to your financial goals. Contact us for the ultimate learning experience. Thank you for watching W3 Wonders. Here's to your journey into the exciting world of investing.